Well, the biggest move is for us in China, and I think that the market is underestimating even now, the effects of the reopening. So, for example, in terms of the travel that we're seeing, they're back at 90% of the normal travel that we saw over Chinese New Year compared to a number of years ago. So I think that reopening is going to go very quick, and of course that has an impact on the region. And I saw a lot of our clients who run businesses there in the region who are very positive about what is happening. Both around the reopening and the supply chain reorientation for ASEAN. But it also has a positive effect on the rest of the world. So I think the risk of a global recession has been reduced significantly.
And yet, even as we look at the way the markets have behaved, and I think Steve summed it up really very neatly here, we've come a long way very quickly. And most of this is valuation expansion, even as earnings estimates and earnings are being slashed. So is there a sufficient basis fundamentally to justify the increase in share prices that we've seen? And, you make the case here that you feel that China is going to be very important in preventing the global economy from falling into recession, but growth numbers still suggest weakness. Leading economic indicators still suggest weakness. And we know now the talk is the Fed goes to 5.5, not 5.
Yeah, so a number of points there. So the first one being that, obviously we had to have those analysts become a little bit more realistic about their growth forecasts. But I think now actually what you're seeing is that the earnings growth for 2023 is around zero, for the consensus in the US. And I think that is, more realistic. We probably need to go into negative territory, but as we know, historically, you don't wait until those earnings forecasts bottom before you see a little bit of a bounce. So a bit more realism. I do think you're right, though, that you have to pick your battles. So, the area that we are most overweight is indeed China and ASEAN, and also, apart from mainland China, also Hong Kong. And that is because there we're seeing low valuations, low investor positioning, and your earnings, which are very pessimistic and which need to go up. So very much the exact opposite side is what we're having in the West. So I think you're right that in the West you can't really have overweight positions. You need to have more visibility. Steve was talking about, do you have more visibility? We don't really have that yet to be overweight on the West.
Willem, I have a problem. I have many problems, as you know, because I come at this from a very limited understanding, unlike you two erudite and qualified gentlemen. If things are so good in China, why do I read this headline on Bloomberg News from over the last couple of days? China's central bank may have more room to cut interest rates in the second quarter as the risk of COVID wave looms in coming months, as the US Federal Reserve ends its interest rate hikes, etc., according to a prominent Chinese economist. Why on earth, if things are so great in China, in an economy which has put on more debt to GDP than any other nation pretty much in terms of the speed of which it's done so in recent times and could become a clear and present danger, if things are so great in China and we're having this great big rally, why are they still talking about cutting rates?
I haven't seen that article, but there is the potential indeed for a little bit more monetary...
Let me put it another way, Willem.
Yeah.
They're not talking about hiking rates.
No. Well, which they don't need to, because we don't have an inflation problem. Actually, PPI is so weak that even if you have a little bit, we have this discussion all the time with our clients. Is the China rebound going to lead to an inflation spike?
Yes.
And it's not, because basically what you have in the Chinese economy is, number one, for the moment, you had this disinflation problem rather than an inflation problem. And the second bit is that your reacceleration now is a consumer-led story. It's not a construction story. It's not an infrastructure story this time around. So therefore, it's not going to lead to that demand for metals and so on that then would feed through into, inflation in the West. So, they can support growth. I do think that is an insurance against the weakness that some people still think you're going to have on the first quarter. I think people will actually be surprised by the strength there. But from the second quarter, you can see a sharp acceleration.
Let me run